Okay, welcome, guys. It is Sunday night, August 24th, in preparation for the last week of August trading here before a holiday weekend next week on Monday. So we're going to jump into the keeping score, calculating risk with Roy Longstreet in his viewpoint of commodity trader book before we jump into the markets. So I've got some interesting things to go over here in the markets with you guys. So I'll try and hurry this up. All right, keeping score, calculating risk. In in the ancient port of Genoa, the mariners had a saying: "Know your limits and where you are if you want to get where you are going." But in those days, if you were daring enough to sail out of the sight of land, knowing where you were was always a problem. From Genoa, almost 5 centuries ago, sailed Columbus, expecting to find a new route to India, finding instead a new world. He had to navigate chiefly by dead reckoning, a most uncertain method, considering the enemies that he faced, time, distance, and the trackless, uncharted sea. Not until 1731 did John Hadley, an Englishman, demonstrate an instrument for navigating destined to become the forerunner of the modern sextant. This device would enable daring sailors to plot their course and to calculate their position, reducing their risk and making their lives less hazardous. In other pursuits, as in navigation, plotting your course and calculating your risk usually pays dividends. My college teammates and I never considered the possibility of losing. Some of our most humiliating defeats came as a result of overconfidence. Later, training to be military officers, we were taught the value of neither overestimating one's own power nor underestimating that of the enemy. These lessons from the past can be applied to the present in commodity trading, where your power is capital and others in the market are your enemies, just as the mariner relied on his sextant. I strongly recommend that each and every trading day, that each and every trading day, that you calculate your risk in open trades. Follow this practice faithfully, and you will always have a good idea of just where you are in relation to where you want to go. Never risk all of your capital in one trade. Diversification is a good rule. Professionals who can risk more on any one trade than amateurs seldom do. Since there is always the possibility of surprise in thin, dead markets, less capital should be risked there than in markets which are broad and moving. So I thought that's interesting. So when it's when the markets are not moving very good, it's low volume chop and things like that. Speaking of that, UK banks are closed tomorrow, so that could lend to a little bit of a low volume day tomorrow. So just throwing that in for a little bonus there. But low volume environments risk less, don't risk more. Many find it a good rule to limit the risk in any one trade to a maximum of 10% and the risk in all open trades to a maximum of 25% of trading capital. Unless the market presents an unusual opportunity, some traders keep risk in any one trade to 5% or less, and in all trades, 15% or less of trading capital. Risk should always be calculated as a percentage of available capital or equity. Determine this each day, adding profits and subtracting losses in open trades, and combine this with net figure with your trading capital. The above may seem somewhat academic, but it is just as important as one's appraisal of the market. I have seen far too many traders get careless about calculating their risk, about knowing their own particular score, about knowing where they were in relation to where they were going. This mistake is usually fatal. Be a good trader. Do your homework each day. All right. And then we're only going to read this last one here. Keeping score on selectivity. Do you play bridge? If so, do you bid 7 spades on every hand, or worse yet, 1 spade? It has been rightly said that the life is a matter of selectivity. There are opportunities each day. The question is, which ones do I select? How does one go about the important job of selecting the best trades available to him? Trading is still an art. There is no substitute for good judgment, but there are some measurements that can assist one in his decision. I have found that the ratio of profit expected to potential loss is a quick reminder. I am more impressed if the potential profit exceeds the expected profit. I'm more impressed if the potential profit exceeds the expected profit. Since it is very unlikely that you will make a profit on every trade, it is important that you develop skill in the art of selecting those trades which will make you more money when you are right than when you lose, and when you're than when you lose when you're wrong. By the way, that goes back to some of the stuff that Buddy's really been doing good at. Trying to keep your risk to a 1-to-1 ratio, or 1 to 2, like one risk, one for two. You're doing great at that. Keep up that work and keep being selective of your trades. I think that you're on the right path there. Okay, so I'm here. The trick, of course, lies in accurately appraising the profit that can be reasonably be expected, as well as appraising the loss potential. This is an area in which an experienced researcher or trader has an advantage over the amateur. There must be no wishful thinking in such an appraisal. The ratio of profit expected to margin required is of passing interest only, since one should always have available capital in excess of your margin requirements. However, should the margin requirement be substantially less in one instance than another, as is usually the case in straddles, I give it weight. And here we go. Whether you do your selecting with the help of the tools described above or by some other means, it must be done. Pardon me. Okay. Do you allow for error is the next one, but we'll get into that tomorrow night. Okay. Put this here. And let me make one quick note here. Sorry, hang on one second. Okay, I'll get back to that. All right. So what I have here is on the SPY. Let's first of all, I wanted to look at the volume that I have up here. You notice that I thought I had that there. So this is a 1440-minute volume. You notice how the volume is waning here. We did have a decent volume on Friday that did exceed the past 1, 2, 3, 4 days. So Friday volume was the highest volume of the week there. So that's interesting in relation to the charts there. So let's look here. So this high volume here was on a down candle. This is the SPY, remember, which is basically kind of synonymous with intraday price action. So down volume there. The next highest volume was here on down volume. Well, now we had, so that was that down volume. We proceeded down, and then Friday, we exceeded this whole week's worth of volume, was exceeded here on Friday. So I'm looking at that. I want to be conscious of that. One of the other things I made note of here is we did, so here I'll expand on this here a little bit. So we did break from this 3-bar. So here was the high, here was the low. This was at 646.19 up here. This was 642.34 down here. We broke below it. Now we not only traded back up into that 3-bar, but we actually took out the high slightly. We were 646.19. We hit a high on Friday of 646.50. So I put a Fibonacci in here. So let me label this. Boom. So I put a Fibonacci here of the day's range. This low of the 3-bar, 642.34, comes in just above the 50% mark here on the SPY. So I would not anticipate a full retracement back down to 50%, because I would not want to see us back below here. If we were, then I would definitely be looking at shorting that. I look at this as a false breakout. So what I'm anticipating tomorrow is honestly a little further continuation up. However, if we're trading back below this 3-bar low, that's going to have me suspicious, or suspect of this move up here. So due to Friday's price action, I do anticipate I do have Monday as a potential as a buy day as well, for additional follow through, and that kind of goes with, if you close strong on a Friday, you usually have continuation on a Monday. So I am anticipating that continuation there. I don't want to see price below that 50% or below this the 3-bar low there. And then let me pull over this 2-minute chart. I so on my 2-minute chart, I have, oh shoot, hang on. Well, I'll just zoom in on this so you can see this. So here was the price action, on Friday. So this is that move up here into 10 o'clock. This was the 10 o'clock candle here. Comes in right at 10:01 here when we started that big move up. So that was a pretty big 2-minute candle. So I went ahead and marked horizontally here. This was that low of the 3-bar. So that low of the 3-bar there, sorry, get back to this. You can see that goes into this, what I would call a low developed area, or single prints area. Well, I don't call it that. I got that term from Damon, but it's a low developed area, single prints. Again, this is a 2-minute candle, and we shot up, quite a bit there. Matter of fact, the low of that was 638.13, the high 642.78. You can see that same type thing on the futures chart there. But anyway, if we were to roll back over and come back down below this level, that would not bode well for this move up, at all. So I basically want to see us continue strong and stay up there on that price on open tomorrow. So all right, so that's all I have on that chart. Let me get that out of the way. One second here. Oh, sorry. Okay, I wanted to pull over nope, that's 15 minutes. 2-minute. Oh no, I want to hold off on this. So let's go to internals here. So on the internals, basically the only thing I have here is watching this VIX, because Thursday's high on that VIX was up here at 1724. So that puts our 3 points down at 1424. We closed Friday, we closed at 1422. So we closed below that on the VIX. So basically, if the VIX is below this 1424 level, that lends more towards the potential bullish side or long basis, just based on that 3-point move. Although that did happen really fast, so we could come back up in here a little bit on that VIX. So we'll have to see how that plays out in the morning. On the gap chart or intraday chart, I wanted to see here. We ended up hitting the 15-minute moving average into the close of day here, or about 3:45, I believe it was. Yeah, so 3:45. That shot up, moved sideways. We just sideways consolidated until we hit this the moving average, which is this blue dotted line here. So we did hit the moving average. There's a lot of signs that I'm seeing that point towards additional long for Monday follow through to the upside. However, I do want to pay attention that those SPY levels, should we start to fail or do any significant pullback, if we're holding above those zones, it would still support the buy day thesis. Again, if we move back below that 3-bar on the SPY, then I would probably be changing my tone to a little more short basis, just because of a failure breakout there, so to speak. So. All right, that's all I have for tonight, guys. Thank you for listening, and we will follow up tomorrow in the room. So see you then. Oh, happy trading, safe trading.